Welcome back, everyone, and thank you for joining the channel. You might think that Iron and Applied Digital are just two AI data center stocks riding the same hype wave, but the reality is very different. One of these companies has seen its stock surge nearly 400% in the past year, while the other has secured $16 billion in hyperscale contracts. Both are now competing to dominate what could become the backbone of the AI economy. Over the past weeks, I've spent hours analyzing their infrastructure, GPU financing, revenue models, and analyst forecasts, and what stands out is a clear divide between two completely different AI business models. In this video, I'm going to break down which company is actually building the stronger AI infrastructure platform, how their revenue models work, and finally, which stock analysts think could deliver the biggest upside from here. In a sector that is evolving as fast as AI, choosing the wrong model could mean missing one of the biggest technology infrastructure shifts in history. I am not a financial advisor. The information provided in this video is for educational and informational purposes only. It should not be considered investment advice, a recommendation to buy or sell any security, or a solicitation of any investment strategy. Always do your own research and consult with a qualified financial professional before making any investment decisions. Stocks and cryptocurrency investments are highly volatile and can result in significant losses. Past performance is not indicative of future results. Iron Limited operates massive data centers designed for power-intensive computing. The company owns the land, power infrastructure, and computing hardware across multiple sites in North America. Historically, Iron focused heavily on Bitcoin mining, using huge amounts of electricity to run mining machines validating transactions on the blockchain. Now the company is pivoting toward artificial intelligence and high-performance computing. The logic is simple. If you already run power-hungry data centers for crypto mining, you can repurpose that infrastructure for AI workloads, which also demand enormous computational power. As part of this transition, Iron is building renewable-powered facilities that can support both blockchain operations and AI training workloads. Applied Digital approaches the same opportunity from a different angle. It builds and operates digital infrastructure specifically for AI and high-performance computing. The company's platform includes large-scale data center hosting, GPU cloud services, and computing infrastructure used for machine learning workloads. These facilities cater to hyperscalers, enterprises, and emerging technology companies needing massive computing capacity. Unlike Iron, which historically ran most computing activities itself, Applied Digital focuses on building infrastructure and leasing capacity to clients. While this difference may seem subtle, it fundamentally changes their business model and explains why the two stocks have behaved differently in the market. Looking at stock performance, Iron trades around $40 per share, up roughly 6% year-to-date, but over the past 52 weeks, it surged about 398%. Such a move reflects investors pricing in massive AI expansion opportunities. Applied Digital trades around $28 per share, up about 15% year-to-date, and over the last year, it climbed approximately 265%. Early in the year, both stocks moved in near lockstep from March to August, reflecting a shared AI data center narrative. After peaking, both pulled back sharply and began moving with wider swings, which is common after fast parabolic runs as early investors take profits and volatility increases. The key takeaway is that while both benefited from sector momentum, Iron attracted more aggressive speculative capital and delivered the larger price surge. Growth drivers further illustrate the contrast. Iron is expanding its AI infrastructure rapidly and has secured $3.6 billion in GPU financing tied to its Microsoft partnership with interest rates below 6%. Combined with a $1.9 billion Microsoft prepayment, most GPU project costs are effectively covered. Iron aims to deploy around 140,000 GPUs, targeting roughly $3.4 billion in annualized revenue by the end of 2026, while also developing new data center capacity across North America. Applied Digital focuses more on expanding infrastructure and locking in long-term contracts. It is building new facilities, including the Polaris Forge campuses, to increase power capacity available to AI and high-performance computing customers. The company has secured about $16 billion in long-term hyperscale leases, expected to generate around $1 billion in annual revenue, and plans to separate its cloud division into Chronoscale, allowing clearer strategic focus and capital allocation for both infrastructure and cloud operations. Revenue structures highlight the core difference. Iron's revenue mainly comes from AI cloud compute contracts tied to GPU deployments, with over $500 million in annualized revenue targeted from roughly 23,000 GPUs by early 2026, about half of which is already contracted. These shorter-term agreements generate recurring revenue based on GPU utilization. Applied Digital's revenue comes primarily from long-term data center leases. Contracts include a 15-year lease with CoreWeave covering around 400 megawatts of capacity, valued at roughly $11 billion, plus additional hyperscaler contracts worth about $5 billion. Applied Digital operates like a landlord, leasing power and data center capacity, whereas Iron sells AI processing power directly through its GPUs. Valuation and volatility further differentiate them. Iron's market cap is about $14.6 billion at $40 per share, trading around 26 times sales and 5 times book value with a 60-month beta of 4.31. Applied Digital has a market cap of roughly $8 billion at 28 per share, trading 51 times sales and 5 times book value with a beta of 7.2. Both are extremely volatile, and the market is pricing them based on potential future growth rather than current earnings. Applied Digital's higher revenue multiple suggests expectations of faster growth or stronger expansion. Analyst consensus shows optimism for both. 14 analysts rate Iron as a moderate buy, with an average score of 4.29 to FID and a high target of $125, implying 230% potential upside. Applied Digital has a stronger buy consensus with an average score of 4.79 or 5 and a high target of $99, implying roughly 254% upside. Ultimately, the choice depends on the business model you believe will capture the most value in the AI infrastructure race. Iron's compute-focused model could benefit most if AI demand explodes, while Applied Digital's contract and lease model offers predictable long-term revenue. Both companies are still early in their AI transitions, and execution speed, customer acquisition, and capital access will determine the long-term winner. Hear from you. Between Iron and Applied Digital, which stock would you choose today, holding or watching you? Share your thoughts in the comments below. And if this analysis helped you, please like the video and subscribe to the channel so you don't miss future deep dives into AI and tech investing. Thanks for watching, and I'll see you next time.